Hello and welcome to Moneylife News and Views. I'm Debashis Basu. Investors worldwide are positioning themselves for a stock market surge, encouraged by signals that the US Federal Reserve will soon cut interest rates. Now, after all, the conventional wisdom is that stocks rise when Fed cuts rates. Expectations of a 0.5% cut at this month's Fed meeting are growing, since inflation has cooled off significantly and it's now nearing about 2%, which is Fed's target. The question is, will rate cuts automatically lead to higher stock prices? Disappointingly enough, historical data shows that interest rate changes, whether rate hikes or rate cuts, are not strongly correlated with stock market performance subsequently. And that is when measured against broad market indices such as S&P 500. Let's begin with a recent example, which is the other kind, that is rate hikes. In mid-February 22, I had speculated in here whether markets would actually rally if Fed raised rates to combat inflation. This hypothesis contradicted the orthodox belief that markets fall during rate hikes and rise during rate cuts. My view was derived from publicly available data. What happens when Fed raises rates? For instance, between 2004 and 2006, mid-2004 and mid-2006, the Fed raised rates 17 times. And what happened to S&P 500? It gained 46% in 2 years. Similarly, from December 2015 to 2020, that's over 5 years, the Fed raised rates 9 times, from 0.25% to 2.5%. That's 10 times, right? 10 times the increase. And the S&P surged from 1900 to 2800. So in these two cases, at least, as the Fed kept on increasing rates, the market went up. There's a reason for this, and I'll explain that later. Interestingly, the index actually wobbled in 2018 towards the end of the first 3-year rate cycle, not at the beginning. So what happened to 2022 when Fed was increasing its rates amid continued rate hikes by the Fed and the ongoing Ukraine conflict? The market indeed dipped for a few months, but yet, defying conventional wisdom, the market rebounded even before the Fed had completed 1/3 of its intended and eventual rate increases. Let's look at what the market did as the Fed was increasing interest rates. The S&P 500 hit a low of around 3,500 in October 2022, and then climbed all the way to 4,600 by July 2023 as rates went higher and higher, and so did the index. During this period, the Fed raised rates 6 times, from 3.25% in November 22 to 5.5% by July 2023. Intriguingly, after the Fed paused its hikes in July, the S&P 500 declined until October, exactly opposite to what people expected. Then from October onwards, however, the index surged relentlessly to 5,650 until a sharp correction last week, all the while the economy contended with a high 5.5% interest rate, which was making everything quite expensive for the borrower. In a full cycle, rates rose from just 0.25%, that the low kept after the COVID, to 5.5%. Imagine, from just 0.25% to 5.5%, and were held there for a year. And yet, the market continued to march higher. Obviously, the market went up to a tune different from the Fed's. This isn't the first time a presumed correlation between the Fed's interest rate and stock market movements proved unreliable. What about the opposite scenario? Do markets rally when the Fed cuts rates? Here too, the relationship is weak. The most striking example comes from 2008. In January 2008, the Fed cuts rates from 3.5% to 3% following a market crash. By March, bear stance collapsed, prompting another 0.75% cut down to 2.25%. In April, rates were further reduced to 2%, And yet the market spiraled downwards between June and September when Lehman Brothers collapsed in September. In October, rates were slashed down to 1.5%, then to 1%, and then by December 2008 down to 0.25%. Despite these drastic cuts throughout the year, the 2008 crash ranks among the worst, the most severe in the modern history, with S&P 500 plummeting 50% from January to March, precisely when rates fell from 3.5% to zero. Far from boosting the markets, the cuts could not even prevent a crash. The same pattern occurred in 2001. The Fed cut rates from 5% to 1.25% by November 2002, and yet S&P 500 dropped from 1530 in August 2000 to 794 in September 2002, almost half, only recovering after March 2003. Why then do many persist in believing that interest rate movements are strongly correlated with stock market performance? Perhaps it's intuitive. In money, the lifeblood of the market becomes more expensive. It would seem logical that markets would falter. And yet, other factors are at play, explaining why stocks can rise even as rates increase, or vice versa. Stock markets can fall even if the rates are cut. Typically, the Fed raises rates in response to robust economic growth, which may manifest as higher inflation. In a strong economy, corporate profits grow, leading to rise in stock prices. Stocks are less concerned with conventional wisdom of rate hikes and rate cuts and their impact on stock prices than with corporate fundamentals and valuation. As the economy expands, Fed hikes rates incrementally. If growth remains solid, corporate profits rise, lifting stock prices. Strong economic growth can prompt further rate hikes. The cycle of rising rates and rising stock prices illustrates that Fed often follows the economic cycle, does not lead it. Now, could the unthinkable happen now? That is, could markets fall when rates are cut? It's quite possible, only under the right condition, which is slower growth. When Fed stops raising rates, it can signal that economic growth is already slowing. Remember, the Fed lags and does not lead, which could hurt corporate profits and consequently stock prices. Sometimes, even rate cuts can't reverse a downturn if prior hikes were very aggressive. Growth slows, whether due to rate hikes or other factors, the market will react negatively. Of the many forces shaping stock prices, economic growth, corporate profits, and valuation are paramount. These deserve far more attention than interest rates movements alone. If you liked what you heard, please do subscribe and do not forget to share. Thanks for watching.